What's up everybody, my name is Ale and welcome to my world of finance. I recently got asked the question, what is a PS ratio and how is it different from a PE ratio? So I'm going to quickly explain both and then I'll give an example at the end so that you fully understand everything about them. Now PS ratio stands for price to sales, and you're looking at that comparative ratio to evaluate whether you are paying a lot or a little for a stock based on the company's performance. Now let's simplify that a little bit by looking at price. And price is the same thing as market cap or market capitalization. And remember that the market cap is the value of the company's shares. In other words, it's the price of one share multiplied by the total number of outstanding shares of the company. Okay, so if price is the market cap, then sales is the revenue or the money generated from sales. And so if it's a comparative ratio, then we're looking at price to sales, we're looking at price divided by sales, or the market cap divided by the revenue. So in other words, you are dividing the cost of the company by its performance, or the price per share by the revenue generated per share. And you can see why this would be valuable to an investor, because it gives you an idea of how expensive the stock is. You would obviously want a low ratio, which would mean that you are getting a cheaper or lower price for a stock in comparison to the company's performance, which would hopefully be high. And so you might look at a stock like Snapchat that has a very high PS ratio of around 20 and think, man, this stock is very expensive. I'm paying a lot of money for a stock in a company that isn't performing well enough to justify this share price. But of course, you have to remember that a PS ratio is only one small piece of the giant puzzle. And you also have to remember that different companies, and especially different sectors, will have their finances structured completely differently sometimes. You may also be paying a higher price for things like future growth and future potential. You may not be investing in Snapchat for how it's performing right now, but you may be investing in Snapchat for what you think it can do in the future. Now, a PE ratio uses price the same way as a PS ratio, but here we replace the S, sales, with E, earnings. Now, we already established that sales stands for revenue. And so in a PS ratio, you're looking at market cap divided by revenue. But in a PE ratio, we're looking at earnings, and earnings stands for profit. So in a PE ratio, we're looking at market cap divided by profit. And you see, when a company operates, it will generate operating revenue, but it will also generate operating expenses. And so to get the profit, you need to take that revenue minus those expenses, and that's how you get the profit. So that's the difference between the PS ratio and the PE ratio. Now you may be asking, well, aren't some companies not profitable? And the answer is yes. Some companies are not profitable, and so in those situations they do not have earnings, they have a negative earnings, right? They're losing money. So in those situations, we might either give them a negative PE ratio, or we might just not give them a PE ratio at all. So whenever you see, a stock does not have a PE ratio, it's because they're not profitable. And so in those situations, you could probably just look at the PS ratio instead. Okay, now let's run through a quick example so that we can see how it's applied and how it compares. So let's take a look at AMD versus Intel. These are two companies that are often compared a lot. So we'll look at those. This is just an example. This is not actually what they trade at, but just an example. So let's look at the PS ratio of the two. Let's just for an example, let's say that AMD trades at $10 per share. And let's say that they also generate revenue of $10 per share. Okay, so you have the price at $10 and you have the sales also at $10. So price divided by sales, 10 divided by 10, you get 1. So you get a PS ratio of 1. Now let's look at Intel. Let's say that Intel trades a little bit more expensive at $20 per share, but let's say that they generate the same amount of revenue at $10 per share. So in this case, you take the price, $20, and you divide it by the sales of $10 and you get 2, right? 20 divided by 10 is 2. So now you have a price to sales ratio of 2. So AMD is at 1 and Intel is at 2. And so in this comparison, you might say, well, AMD is cheaper because I'm paying a cheaper price because it has a ratio of 1, whereas Intel has a PS ratio of 2. Okay, now let's run through a similar example, but let's look at the PE ratio instead of the PS ratio. So now we're looking at price to earnings. So let's say that AMD and Intel are still trading at the same prices as before. AMD will say is trading at $10 per share, Intel will say is trading at $20 per share. So now when you look at AMD, let's say that they have profit of only $1 per share. Okay, so before they had revenue of $10 per share, but let's say that they're only making profit of $1 per share. This is otherwise known as earnings per share, or also known as EPS. You may have heard of EPS a lot. It gets thrown around a lot, and so that's what EPS stands for. So now you've got $10 price per share, and you divide that by the earnings per share of $1, so 10 divided by 1, and you get 10. Okay, so their PE ratio is 10. And this is kind of high in comparison to the next example I'll give for Intel. So let's say that Intel is trading at $20 per share, and they were generating revenue of $10 per share, but let's say that their profit is actually at 5. Okay, so they're making $5 per share, EPS of $5. So AMD was making 1, Intel is making 5. Okay, so maybe AMD was spending more money on investments, or maybe they were just blowing money, whatever the case is. Intel was able to bring in more profit out of the same amount of revenue, okay? So now with Intel, you have $20 price per share, and you divide that by the earnings per share of $5, and you get 4. So their PE ratio is 4. So now in this situation, you have AMD with a PE ratio of 10 and Intel with a PE ratio of 4. So now, even though AMD had a better PS ratio, Intel has actually a better PE ratio, and so now Intel is starting to look like a better stock to invest in. But the thing that you guys have to remember is that these are all just small pieces of the giant puzzle, okay? There may be reasons why AMD would have a higher PE ratio. It might be more of a growth stock, okay? You might be investing in the future for AMD, whereas Intel might be more of a value stock, okay? So lower PE ratio might be more of a value stock, higher PE ratio, you may be looking more towards the future, more towards growth potential and things like that. So anyway, I hope I didn't confuse you guys too much. I know it's a lot to take in, but hopefully this will start to sink in later. But anyway, I'll be making more educational videos. Make sure you subscribe. I hope you enjoyed the video. Hit the like button, and I will see you guys next time. Have a wonderful day. Take care.